Oh, that's crazy. China is collapsing and we're seeing a massive crash in the bond market. The whole thing is extremely explosive for Bitcoin, important for Bitcoin, and will also cause Bitcoin to continue to rise. It's not that Bitcoin is skyrocketing right now. It's just that fiat currencies keep losing value against Bitcoin over and over again. This leads to the dollar getting stronger while China is massively devaluing, but at the same time, Bitcoin is appreciating in the long run. We're going to take a look at what this all means and why this event is so important right now. This leads to the dollar becoming stronger, China massively devaluing, but at the same time, Bitcoin also appreciating in the long term. We look at what it is all about and why this event is so important now. We had this some time ago, and I have reported on it several times that various stimulus packages were announced by China. And it looks like no matter how much China tries to stimulate things and heat up the market, they just can't seem to get the economy stabilized. The economy is slipping away from them or crashing into a wall, and now China is desperately trying to save the economy by putting their currency at risk. I found this article that says China is collapsing, and liquidity injections are their last-ditch effort to boost growth while bond yields are plummeting. The economy is slipping away from them or crashing into a wall, and China is now desperately trying to save the economy by putting their currency at risk. I found this article that says China is collapsing, and liquidity injections are their last-ditch effort to boost growth while bond yields are plummeting. There's nothing you can do against demographics. And if we look at the chart here, we can see that the bonds, the 10-year bonds, are falling by almost 4.5% on a daily basis. For a bond market, it is truly horrific. That doesn't mean it's like Bitcoin, where 5% is nothing in the end, but for the bond market, this is a massive step backwards. It's clear that liquidity injections are being pumped into the market, and demographics are also causing problems. We're also going to take a look at the reasons why these bonds are currently falling, why this is critical for China, why it's critical for the global financial markets, and why it's actually positive for Bitcoin. Because Bitcoin benefits from weak fiat currencies. The weaker fiat currencies are, the more Bitcoin can pump up. To be honest, it is ultimately just a game of perspective. Bitcoin isn't really pumping up that much. It's just that the other currencies are losing value against Bitcoin more and more. And then it creates the illusion that Bitcoin is shooting up, but really it's the other currencies that are losing value against Bitcoin. And the reason why bonds are crashing right now, or why bond yields are plummeting, can have various causes, for example. When investors flee from the stock market into the bond market, or when, for example, investors expect that interest rates will be lowered and they want to take advantage of the high interest rates now. Understanding bonds' inverse relationship is key. Buying bonds lowers interest rates, selling raises them. Currently, rates fall as bonds are bought in China due to stock market issues, as Yahoo Finance reports. Poor economic outlook, bad job data, and rising unemployment lead investors to bonds, dropping rates. So it's really important to understand this. In 2021, we have falling interest rates, which means that people are massively buying bonds in China. And if you look for the reasons behind this, you quickly come across articles like the one from Yahoo Finance that says the Chinese stock market is facing its biggest problems since 2016. This is exactly what I just mentioned. When the stock markets are in trouble, investors flock to safe havens, and in China, the safe haven is bonds. So we're seeing a massive shift because the economic outlook for China is very, very poor bad job market data, rising unemployment, and so on. Demographics were mentioned earlier, and then what happens? People get out of the stock market, then they get into bonds, and then the interest rates go down. This may initially be positive for the bond market because more bonds are being bought, which means that government refinancing will then become much cheaper. But this is only the consequence of the weakening economy, of the weak economy, and this has much deeper causes, and that is ultimately the official story here too. The article also mentions that Chinese stocks have had their worst start to the year in almost a decade. Can you believe that? Investors are bracing for economic uncertainties, which ties into the speculation about interest rates. They want to take advantage of the high rates while they still can, especially with the uncertainty triggered by weaker than expected production data, and an anticipated increase in tariffs. So it's kind of similar to what Trump is pushing for, where he suggests imposing tariffs to strengthen the domestic economy. The idea is that by putting tariffs on products from other countries, you can boost your own economy. But the downside is that it can lead to higher prices, which ultimately lowers the standard of living and creates other issues. And that's the official story. This means that the official story here in China is currently, hey, the economy is bad, people are fleeing from stocks into bonds, and that is why we are seeing a massive drop in interest rates. But now there are highly explosive insights into why interest rates are really falling, and we have seen this again and again and again in history, for example. The effect happens where suddenly interest rates drop, and then you have the average clueless investor thinking, oh, okay, people are just buying government bonds more because they're interesting, maybe because the stock market isn't as appealing or for other reasons. But if you dig a little deeper, you'll see that historically, When there are significant drops in interest rates, it's usually because central banks are indeed involved. That means when no one else is buying the bonds. Central banks truly step in and buy up massive amounts of these government bonds, which definitely drives interest rates down significantly. This creates the illusion for the clueless investor that these bonds, whether it's US Treasuries, German bonds, or Chinese bonds, must be in high demand. They think, wow, these bonds are as sought after as melons in El Salvador. I don't know what the hot item is in El Salvador, but I always go for the melons and papayas. In 2021, that's definitely the top choice, and now we see bonds sinking, and we have confirmation of this, because there's speculation under this post about why bonds are crashing so hard. Indeed, it is certainly a complex situation. Someone's asking, you wrote about liquidity injections as a last-ditch effort to boost growth while bond yields are crashing. Do you think that the drop in bond yields is a result of China's liquidity injections? And is this injection happening because China is collapsing? And then they simply say, yes, that's exactly what's happening right now. Liquidity injections are essentially the same as quantitative easing, and that was announced a while back. I haven't actually found any official reports stating that China has implemented quantitative easing, but if we just look at the bonds and their yields, we can see that there are some massive buyers out there. So it could really just be that the stock market is struggling, and that's why people are moving into bonds. But with such a drastic drop, it's likely that central banks are involved. So this is just speculation. I haven't actually found any confirmed sources, except for a few people saying, yeah, that's definitely the case. But I haven't found any official confirmation from China. Could very well be that, like so often, they don't officially disclose this and then just announce it 3 or 4 weeks later or something. There are even scenes where it somehow only just happens. Wasn't that with the Brits or something, where it only came out like 100 years later, that they had sold war bonds and that, let's say, 50% or more of those war bonds were bought up by their own central bank. And all those people back then, I think it was in Great Britain, but I'm not entirely sure, who bought those war bonds thought, wow, these war bonds are flying off the shelves, everyone wants them, they're super hot. But then it turned out like 100 or 150 years later that they weren't actually in demand at all. It was just the central bank that had bought up 50 or 60% of the supply. People had the illusion that there was a huge demand, and that's exactly what I mean. You shouldn't be one of those clueless investors. You need to be among the smart investors, or rather, I actually hate the term smart savers because Bitcoin isn't really investing. It's more like saving. You really need to understand what's going on here. When we see such drastic interest rate moves, it's often due to interest rate manipulation. Central banks can easily control short-term rates through the key interest rate, and that's what they've been doing all along. It's pretty straightforward. But controlling the long end is a bit trickier. Historically, they like to use quantitative easing for that, which means the central bank buys government bonds that no one else is buying on the open market, and that drives the interest rates down. Everyone thinks, wow, the demand for government bonds is so high right now. But in reality, it's just a huge fake number. And this fake number could really kick off here right now. Here you can also see an article from 3 months ago, which mentioned that China's central bank is implementing its most aggressive stimulus since the pandemic. So back then, they announced the stimulus packages, saying they wanted to lower the key interest rates, reduce the reserve requirements, and that they were going to do quantitative easing and whatever other stuff they had planned. And now we see the effects in the interest markets. Now, the interesting part is, why is this important for Bitcoin? So first of all, we need to recognize that when the Chinese currency weakens significantly, the dollar gets stronger. We're also seeing that the DXY, which is the dollar index, is shooting up massively. It's not just because the dollar is so strong. It's also because other currencies are weak, like the Chinese currency, which is depreciating massively, 2001. And now we need to understand that when the DXY, which is the US dollar index, is strong, then Bitcoin is weak. So that means it's bad news. China's currency is depreciating, the dollar is getting stronger, which actually means that Bitcoin is going to be weaker because Bitcoin has a really strong correlation with the dollar. But that's just the first look. At first glance, it looks like the dollar is getting stronger and Bitcoin is getting weaker right now. View this globally. China's quantitative easing boosts the global money supply, 2001. Because when the global money supply changes and we don't just focus on the dollar and its strength, but look at the global money supply, we realize, hey, when China fires up the money printers, and that's nothing but money printing quantitative easing, then the global money supply increases. And if the global money supply increases, whether the dollar is stronger or weaker, then Bitcoin will also rise. This means that Bitcoin is clearly a winner here. And again, Bitcoin is the beneficiary here, not because Bitcoin is so strong, but simply because fiat currencies are so weak. There's always that saying, you don't have to be faster than the wolf or the lion or whatever when it catches you. You just have to be faster than the last one, which is really poorly phrased, like the last cow that runs away from the wolf or the last, let's say, the last animal or horse that escapes from the lion. Or a really bad example, it was the sheep that runs away from the wolf here. But theoretically, you don't have to be the absolute fastest. You just need to be faster than the slowest one in your group. You just have to be faster than the last one, which is really poorly phrased, like the last cow that runs away from the wolf or the last, let's say, the last animal or horse that escapes from the lion. Or a really bad example, it was the sheep that runs away from the wolf here. But theoretically, you don't have to be the absolute fastest. You just need to be faster than the slowest one in your group. And the slowest one gets eaten by the lion, or for that matter, by some other animal like a hippo or whatever, or by Christine Lagarde, if you ask me. No, Christine Lagarde doesn't eat people. And that's basically the reason why Bitcoin is rising here. Not because Bitcoin is super strong, but because Bitcoin just isn't the weakest one in, let's say, the race. And the weak currencies are going to collapse one after another. Not because Bitcoin is super strong, but because Bitcoin just isn't the weakest one in, let's say, the race. And those weak currencies are going to collapse one after another. Bitcoin definitely won't be at the starting line. And those weak currencies are going to collapse one after another. Bitcoin will definitely not be there. That doesn't mean China is going to end up in hyperinflation tomorrow, but there are definitely some dramatic things happening here. Now, here's a big recommendation for me to really secure your Bitcoin holdings, especially if Bitcoin is heading towards a bull run and keeps going up. I always recommend using a hardware wallet. Don't leave your Bitcoin on an exchange. Always transfer your Bitcoin to a hardware wallet. Here, your Bitcoin is super safe from hackers and any platform risks. I'll put a link down below to a TREZOR hardware wallet, so you can easily store your Bitcoin on this hardware wallet. And you can also save up to 10% if you enter the code Bitcoin Hotel. And then one more big recommendation. Check out Bitcoin, the easiest way to buy Bitcoin in Europe. Absolutely recommended. With the code Bitcoin Hotel, you can also save up to 20% on the fees when buying Bitcoin. See you, take care. Peace out.